Joining me now, we've got Will McGough, who is the Prime Capital Financial Deputy Chief Investment Officer. It's been a wild week for the markets so far. So how should investors be navigating this type of volatility that we're seeing here?
Hey, Brad, thanks for having me on. And you just nailed it with the word volatility. We've been telling our advisors and our clients to prepare for volatility all year, going back into January. We've got a new regime in Washington, D.C. that's obviously causing a lot of the volatility. But more importantly, we had two really good years, 20% plus back to back. So price to earnings ratios were extended to historical extremes. Earnings growth was delivering 12 to 16%. So we were really at peak growth. Like there was hardly any upside left. And, the volatility has obviously been amplified by the trade wars that have started.
And so with that in mind, what is the strategy that a lot of investors would be apt in that volatility and in the valuations that were already kind of going through their own sniff tests at the beginning of the year, even prior to any type of trade war or negotiations on the tariff front being initiated?
Right. So we've been saying you should be coring up exposure. And by that, you just need to be cognizant of what your growth exposure is. The Mag 7 has a lot of concentration. It's large cap growth. It's a lot of large cap blend. So you just want to make sure that it's balanced with value dividend paying stocks to help temper that volatility. So there's a few ETFs that we've liked and used, dividend growers from Wisdom Tree, quality factor ETFs from BlackRock, to kind of help just core up exposure so that you don't want to really take too much extra risk with growth. You want to be well diversified, finally, for the first time in probably 15 years, away from the Mag 7. Just simply be market weight, not overweight.
Now, globally here, how are you looking across some of the opportunities, especially knowing that U.S. stocks and U.S. exceptionalism was the trade to begin the year that we had heard from a lot of firms, but now it seems that we've seen some shifts.
Right. There's been massive shifts with the international investing landscape. You really haven't needed international exposure for the better part of 15 years. U.S. markets have dominated the world. But what we're seeing, and some friends from way back in the day used to always tell me to follow the money. So what's happening abroad is a focus on spending. We're trying to bring deficits down. Doge, we're trying to increase revenue through tariffs. So essentially, there's a tightening going on here in the States. Well, with some of Trump's policies, he's encouraging foreign countries to ramp up their defense spending. So you're seeing foreign governments in Germany and Europe, more specifically, spend more money. So if you simply follow the money flows, you're seeing money flowing out of the States and abroad, which has caused a massive divergence in performance this year for international, specifically European ETFs versus those here in the States. So again, it's finally, you need to be diversified. You haven't needed that for 15 years with Mag 7, but there's a period going forward where international exposure, small cap exposure, bond exposure makes a lot of sense to help bring down the volatility of the Mag 7 stocks.
Specifically where internationally? I mean, especially as you have headlines now swirling around China and Europe engaging in trade talks, at least in response to some of the tariffs that have been imposed by the U.S.
Right. So we're specifically looking at Europe right now. Vanguard has an ETF there that we've been allocated amongst. And again, it's the European countries. It's really started with the whole Ukraine trade, a war where Trump was wanting to potentially back out of NATO, have those governments increase their defense spending. And it's been a theme that has been talked about going back to last fall, but obviously picked up more and more as we got into the year. You're also seeing the global yield curve compress too. So rates in Europe are going up, where rates here were down. They're all over the place right now. So that compression too also hurts the US dollar, which is traditionally a headwind to international investing. When you invest internationally, you get two things: the currency return plus the local market return. With the strong dollar, currency return was a detractor. With the dollar being a little weaker here, it's a helper. So that's another reason that we like being diversified internationally right now.
And then just lastly, with regard to the dollar, how do you think today's CPI print alters or at least furthers the Fed thinking in order to kind of continue with their own policy pathway, whatever that may look like at this point, because they're as reactionary as the rest of us?
Right. And if you think about past crises, 2000, 2003, 2008, 2020, the Fed stepped in. Here, you got the Fed just sitting back watching. So they're waiting to see data come in, where are rates and inflation going to go. The print today was bullish, backed up a little bit. So that may help them with their cause of not having to tame inflation, and the Fed put may come back. But I think right now, just my personal opinion is that Powell is happy letting the administration in Washington, D.C. essentially help his cause to bring market rates down, which then he'll have to react to. The saying is the bond market knows everything. And right now there's a lot of volatility in the bond market. I'd argue more than the equity markets. And with the fiscal deficits and treasury issuance that's coming, everybody needs rates to come down. And you've got Powell sitting here watching, which is fascinating. Lastly, I think he's finally right on this whole transitory phase. He was wrong after the COVID inflation, calling that transitory, but tariffs, in my opinion, are transitory, if not deflationary. So I think it's kind of a way for Powell to essentially finally be right while also trolling the media a little bit.
Will, thanks so much for taking the time.
Thank you.